The crash everyone fears is not a sudden accident. It is the result of decades of decisions, policies, and hidden mechanisms that no single leader can reverse. The mystery begins with a simple question. Why can't even the most powerful political figure stop what is coming? The answer lies in the machinery of global finance, a system larger than any presidency. To understand why this crash is inevitable, we must peel back the layers of history. Banking systems were never designed to protect ordinary citizens. They were designed to protect themselves. In the early 20th century, the Federal Reserve was created to stabilize markets. But stability was always an illusion, built on debt and confidence. Presidents came and went, but the Fed remained the hidden hand. Wars were financed, economies were inflated, and debt became the lifeblood of growth. By the mid-20th century, the dollar had become the global reserve currency. This gave the United States immense power, but also immense responsibility. Every crisis since then has revolved around the dollar's role in global trade. Nixon's decision to end the gold standard in 1971 was a turning point. Money became untethered from reality, backed only by promises. Debt markets exploded, and speculation became the engine of prosperity. Presidents could influence policy, but they could not control the tide of debt. Reagan's era of deregulation accelerated the trend. Banks grew larger, riskier, and more interconnected. The seeds of future collapse were planted in the soil of deregulation. Clinton's repeal of Glass-Steagall removed barriers between commercial and investment banking. This unleashed a wave of speculation that would culminate in the 2008 crisis. Mortgage-backed securities became the symbol of reckless lending. When the bubble burst, the system nearly collapsed. Bush and Obama presided over bailouts, but the deeper problem remained. The system was addicted to debt, and no leader could break the addiction. The Federal Reserve printed trillions to stabilize markets. Quantitative easing became the new normal. Interest rates were slashed to near zero. The illusion of recovery was created, but the foundation was weaker than ever. By the time Trump entered office, the system was already fragile. He promised growth, jobs, and prosperity. Tax cuts fueled short-term expansion, but also ballooned deficits. Trade wars disrupted global supply chains. The pandemic in 2020 exposed the fragility of the system. Markets crashed, unemployment soared, and trillions were printed again. Stimulus checks gave temporary relief, but debt skyrocketed. The Fed's balance sheet expanded beyond imagination. Inflation returned with a vengeance. Interest rates had to rise, but rising rates threatened the debt bubble. This is the paradox. Every fix creates a new problem. Presidents can sign bills, but they cannot rewrite the laws of economics. The crash is baked into the system itself. The origins lie in decades of debt expansion. The rise came from deregulation and globalization. The breaking point was the 2008 crisis and the pandemic. The fallout is the looming collapse of 2026. Failed fixes include bailouts, quantitative easing, and endless borrowing. The cycle repeats, but the scale grows larger each time. Trump, like any leader, is trapped in this cycle. He cannot stop the crash because the crash is structural. The machinery of debt markets operates independently of politics. Global investors move trillions daily, beyond the reach of executive orders. Sovereign debt markets dictate interest rates. Corporate defaults ripple across industries. Banking contagion spreads silently. The crash is not a single event, it is a chain reaction. It begins with sovereign defaults. Nations unable to roll over debt face insolvency. Investors flee, currencies crumble, and central banks scramble. The second stage is corporate implosion. Companies addicted to cheap borrowing face refinancing at impossible rates. Defaults spread like wildfire. The third stage is banking contagion. Banks holding toxic debt face liquidity crises. Confidence evaporates and dominoes fall. The final stage is systemic paralysis. Debt markets freeze, governments panic, and the illusion shatters. This is why Trump cannot stop the crash. It is not about policy. It is about physics. The system has reached its breaking point. Modern parallels confirm the pattern. Credit Suisse collapsed in 2023. Regional banks in the U.S. face crises in 2024. Sovereign debt markets showed fractures in 2025. Each event was a warning. Each event hinted at the next stage. The data is shocking. Global debt exceeds $300 trillion. Debt to GDP ratios are unsustainable. Interest payments consume national budgets. Deposit insurance funds cover only a fraction of potential claims. Legal frameworks authorize bail-ins. The crash is not speculation, it is law. History repeats itself. The Great Depression destroyed savings. The 2008 crisis destroyed housing. The Cyprus bail-in destroyed deposits. The 2026 crash will destroy faith in money itself. 3 takeaways emerge. Banks are not guardians of wealth. Deposit insurance is a myth in systemic crises. Bail-ins are legal, planned, and inevitable. The warning is simple. Your deposits are not safe. The open-ended thought is chilling. If money in the bank is no longer yours, what is money at all? The call to action is urgent. Understand the system before it understands you. The crash cannot be stopped, but it can be prepared for.